Blacksburg, your host for today. And joining me is my favorite gold mining, gold exploration expert, Peter Gianulis. Welcome back to the show, Peter.
Hi, Gav. It's great to be back.
Great to have you. And what a glorious time for the world of gold. New all-time highs continuing to be set by the price of spot gold. And we're seeing a lot of activity inside of the miners, the junior miners, exploration areas. We're going to talk about all of this. But as we get started here, just first off, could you give a quick introduction to people and then maybe just the thing that's standing out to you the most right now in this world of gold investing?
Yeah, just a quick introduction. I'm the CEO of A2 Gold. I've been the CEO for about 6 years. Took over the company, was a struggling exploration company out of Nevada. Had a market cap of around 3 million, and it took a few years to kind of fix the company and set it on the right path. And I think we've been very successful, grown it to almost $100 million company. Investors have been treated very well over that period of time. Prior to managing A2 Gold, formerly Allegiant Gold, I was a hedge fund manager, worked for Salomon Brothers in the hedge fund group for about 10 years, and then managed my own fund for 10 years in the junior mining sector. So I have quite a bit of experience in this industry and going back over 20, 25 years in the gold and silver, and then in the junior miners, probably around 20 years as well. So I've seen it all, sit on the board of directors of a few companies, had 6 or 7 successful exits over that time. I hope to believe, or I tend to believe that I kind of know what makes a company successful and how to execute that business plan. And at A2 Gold, been doing it for 6 years in a very, very difficult market, contrary to what most people think. The junior miners have really underperformed and have just started playing catch up now. Kind of eerily reminds me of 2004, which was the only parallel I can kind of allude to at this point. And then the juniors went on a massive run of 500% to 1,000 on average, and some companies went up 10,000% over that period of time. It just feels very similar. Going back, I know it's almost 22 years ago, but that's what it feels like to me. So in the gold and the silver market, so the second part of your question, it's unprecedented. I don't know what else to say except that continue to hit all-time highs. Silver broke $92 an ounce today. I can't even believe that number. And gold, continues its path over, hitting 46.50. I think it hit this morning. So amazing margins for the senior miners. Margins for anyone that's mining, it's amazing. And the juniors are starting to react slowly. I think that real capital hasn't necessarily flown into that yet, but it's slowly kind of dripping in there. And since the size of the junior market is so small, that doesn't take a lot of capital to really move this sector. So that's kind of an overview. I can drill down a little bit deeper if you please.
I think that's perfect right off the bat. And mentioning silver as well, they're crazy. It's up like $15 a share right now, just starting out this year on SLV. So it's already just been completely flying. But yeah, there's so much that I want to dig into here. And I really do want to kind of get those cross comparisons from you back to 04. But you had that experience in the industry. Before we do get too far deeper here, you heard Peter mention it. He is the CEO at A2 Gold Corp. The ticker for that is AUAU.V. And this show and this interview is sponsored by A2 Gold Corp. It's intended for informational purposes only. We don't make endorsements, recommendations of specific stocks or investing strategies. And of course, investing involves risk, including the possibility of losing your principal. So please always conduct thorough due diligence prior to investing in anything. With that being said, there's a lot of good information that we're going to put forward here. So let's dig a little bit deeper into what you just said right there. So take me back, 04, what's happening inside of the gold markets, and then how did that reflect into these crazy, like you said, 500 to 1,000% moves in these junior miners?
Well, there are different phases in these bull markets. I think that applies to almost every single market, but I'll tie it back into the junior market. So in 1999, gold hit its really inflation adjusted all-time low, or the low for that cycle, which was about $260 an ounce. And gold then went on a silent bull market, went from 260 to about 450 by 2003. The juniors really did not start reacting until about 2002 and 3, and then they doubled and tripled, and it was I called it almost a a silent bull market from 2002 to 2004, but you would have made a couple 100%. And that's very similar to what's happened in the last 12 months here in the junior industry. Then from 2004 to 2007 and 8, it went on an unprecedented run. And I think the index may have gone up 300-400%. Now that's the index. Individual names, some of the better names went up thousands of percent, and the best, and there were many 5 and 10,000% winners in this industry. But the overall market did well, and that I think that led to, as 2004 started occurring and these returns were great, it started attracting additional international capital, and primarily into the Canadian markets, which tends to be really the central place for junior mining industry, although NASDAQ and OTC has made some inroads into that. But from 2004 to 2007 or 8, it was really just a monster run, and companies that were all run, disciplined, really returns amazing returns to shareholders. And I think, as I said, it's my opinion, but it feels eerily similar to 21 years, 22 years ago. And if I'm right, money's starting to flow in, which is the single biggest factor for returns in this sector. If those flows continue, then that money has to go somewhere. There's just a few places to go. Now, I'll also add one other important element that hasn't really kicked in the junior market, and if it does kick in, then these returns, have the potential to be, significantly higher. That is that senior and mid-major mining companies, and I'm focused primarily on the precious metals, but it applies to copper as well, have really not entered the space in terms of acquisitions, so M&A activity. And many of these companies, the Kinrosses of the world, Barricks and Newmonts and Anglo and Agnicos, are flush with billions of dollars of cash sitting on their balance sheets, really have only three things to do with it. One is to initiate dividends. And they've historically been burned by doing that dividends because the industry is, your returns are volatile enough that it's not necessarily the best use of capital. The second is they'll do a share purchase program. You've seen Kinross do that, and I think you've seen some other majors buying back their shares. But now that their shares are up 400 or 500%, they're also looking at the third element, which is acquisitions. So, mining companies generally spend all year depleting their assets by producing, in the case of Kinross, or 2 to 3 million ounces a year. In the case of Barrick and Newmont, closer to 5 million ounces a year, and they need to replace that every year. So finding an additional 7 or 10 million ounces of gold, and I'm saying in resources or reserves, because you're only going to produce about 5 to 6 million of that. Okay. It is not only time consuming, it's risky, and it's very difficult. And so historically, and I think this probably will be the case, they will now step in and start buying juniors that actually have reserves or resources identified in an economic report. So I think that we are at the early stages of these senior companies going in and buying resources, or reserves through the acquisition of companies. So that's one element. I think that the first element I mentioned, just to summarize, is just capital flowing back into this industry, in the sector. And I'm starting to see the Americans coming in, some of the Europeans coming in. They had stepped away for almost a decade, and for many reasons. But once they come back in, the U.S. is 60 to 70% of all world capital right now. Once that money starts flowing into the sector, I hope you're strapped in, because this is like a rocket ship. So that could happen.
I have a few questions off of that, and one of them is really, how do we know that money's flowing back in? What is the key indicators there? What do you watch? And then the other side of the question is, you mentioned that back in 04, 05, the junior miners that were successful because they were disciplined. And then you simultaneously mentioned that a lot of the opportunity here in 2026 lies in the acquisition markets. And I'm curious, first, if you could speak to the flow of money, how you track that, how you look at it. And then number two, how is A2 Gold exemplifying being disciplined in a market like this, right? And by proxy, perhaps making themselves an attractive M&A target, but also setting yourself up for high upside capture of this swing that we've seen in gold.
Well, the first question, the first part
Yeah,
of
we
that.
could start. So I'll try to remember both. I just want to say
Yeah.
them both so I could remember them. But yeah, let's start
I,
with the money. Yeah.
yeah. So I think on the money side, you look at what financings are occurring, and then looking at, look through their filings with CDAR is where who are the investors. You have to disclose a lot of the investors, what areas and regions they come from, and you're starting to see more non-Canadians coming into the market and participating, and you're starting to see more capital. So that's the first thing I kind of look at too, is fund creation or are new funds being created that focus on the junior mining industry, and I'm starting to hear of a few that have just gotten started. The third is just it's more experience in talking to generalist funds, the Fidelities, the Templetons, the big ones of the world, and how they're allocating into their generalist funds their or how they're allocating their funds in the general funds, and they're starting to rehire mining analysts and portfolio managers are starting to allocate more into the mining sector. So those three things is kind of anecdotal in the case of the generalist funds, but I am starting to see that. So those elements, the financings and fund creation, the generalist funds are all elements that drive capital into this, and you're starting to see bigger banks coming in and doing allocations. You're seeing the level of financings. Typically you would see a $2 to $5 million, $2 to $10 million financings. Now it's commonplace to see 10 to 50 million. So that capital is going somewhere. And to be fair, Canada is not really generating any real wealth, so someone has to be taking it up. And I think that you're seeing more of the Americans and the Europeans playing into that space, and more funds playing into that. The second part of the question is us and discipline. Well, we've kind of prided ourselves over the last 6 years of being very disciplined in how we allocated capital, how we spent money, how we invested in our own projects. We would sell our non-core projects, and we didn't really do a financing for almost 3 years, and that was only to Kinross, who's invested in us in 2 different rounds. But to the general market, we hadn't done a financing. The last financing we did was for 4 years ago, which was in 2021, until we raised some money in 2025. So that discipline, I think most people that know us in the industry, or most of my peers, would say that we are probably one of the more disciplined juniors out there in terms of how we spend money, how we allocate capital. Now, I will say, given the change in the market sentiment, I think we've changed that to being a little bit more aggressive. We're spending more money into our projects now. We're starting to talk more about our company and getting the news out on what I think we're doing well. We're looking at different companies as well and projects as potential acquisitions. I think others look at us as an acquisition target, but I can't really comment on that. And ultimately, our goal is to build a successful large company with significant resources that makes us a target for a larger company to acquire.
Well put. Now, I understand that there's guidelines here that around what you can talk with, but I am curious on the acquisition point, because my audience, a lot of potential retail investors, it's pretty exciting in the market when there's M&A, right? And it can lead to a lot of opportunities. And recently, actually, there was another guy that I was messaging back and forth with. You were talking about a company, and that company got acquired. There was like a 40% move, right? So these are just interesting things. And I'm curious, obviously, people will be like a Kinross or others might be looking for, like you said, hey, how do we get an extra 5 to 10 million in resources here? And that's a pure area there for an acquisition that makes sense. What are the other factors that specifically, something like A2 Gold, like what else makes it attractive for acquisition beyond the resources? Is it the setup, the team, the knowledge? Are there other pieces here, or is it typically more of a pure resource play?
Well, I mean, it depends. So if we were looking at an acquisition, and we at times we've been the acquisition target, and at times we're on the aggressive side that are on looking at acquisitions. From our perspective, the most important thing is jurisdiction. It makes no sense to us to acquire a project in British Guyana, where I have to have a separate geological team out there. It's expensive. I may not know the area well, the politics and all the other aspects there, the legal framework. But when we look at a project, the first thing we look at is it in our area of influence where I can use the same geological team. I don't have to add an additional, separate team to cover that project or that acquisition target. So for us, that's the most important thing. The second thing is, does it fit in well with our project? Are there any synergies besides geological? Can we use some of the shared services? If a company were to acquire us, would they look at the whole package as a whole? Our strategy has always been, be the biggest and best, primarily the best and the biggest junior gold company, gold and silver, because we have a significant amount of silver as well, in Nevada or the area of influence. We've always operated in the Western United States. We've never had anything outside of that. 6 years ago, we had projects in Utah and New Mexico and Arizona, as well as Nevada. Today, we're just focused on Nevada. That may change, but at this stage, we're a Nevada-focused explorer with significant resources. I mean, we're starting with a pretty large head start in the fact that we have a major resource.
Well, let's talk to these resources. There was some news recently. I'll go ahead and just screen share this for a moment over here so that the audience can see. And this was published on your website about A2 Gold drills 2.9 GT gold over 20 meters at the Macintosh zones. People can take a look here, see some of these Macintosh zones. Can you speak to what this is outlining?
Yeah, sure. I mean, so we have two main zone ore bodies. One is the Macintosh zone on the north of our property, and one is the south, which is called Castle. Combined is about 1.5 million ounces of gold with about 9 million ounces of silver. This specific drill program, which operated in October, November, December of last year, we just getting the results out, was designed to target mineralization at depth. And these results were to show that the mineralization didn't end in the previous drill program 4 years ago, that actually could go even further and deeper. And that's what I think we've shown, that the mineralization extends even further at depth, which is a great sign. This deposit continues to be open along all of its dimensions, to the west, to the south, and at depth. The way that I think the best way to characterize it or interpret is that our goals were met by extending mineralization at depth. And it was 3 holes. They were core holes, so they were fairly deep. And it will help us in terms of designing the follow-up program. And as you're reading right now, that our follow-up program is expected to start in the next 2 weeks. It's slated to be an 18,000 meter program. There'll be 3 main objectives of this upcoming program. The first is to infill drill within the pit areas that we have, or the pit shells that we have at the north and to the south. That will be used to update the 43-101 resource estimate. We haven't updated that in almost 4.5 years, close to 5 years. So it's due for an update. And gold, just to remind everyone, gold was about $1,700 an ounce, and silver was $22 an ounce the last time we published a resource estimate. The second goal is to do step-out drilling. So once again, something that could possibly affect the resource estimate that will come out sometime in April or May. Step-out drilling means drilling along the outline of the pit shell. So you're trying to expand the pit shell both in the north and the south, or trying to connect different subzones. And that could potentially positively affect the size of the resource. And then the third goal and objective is to drill certain targets that were discovered and found in our most recently completed project-wide geophysics program. So we had, prior to this last geophysics program, which was completed in the third quarter of last year, we had never shot a geophysics program that covered the entire property. And what was gleaned from those results was that there's significant amount of targets that we still haven't tested. So, just to go back, we've only drilled about 18% of east side. There's significant expansion potential at the property, and the geophysics was the first step. Well, probably the second step. We had done a lot of sampling. The second step was the geophysics to see how it kind of tied together. And now the final step is actually drilling that to prove out your hypothesis of these potential targets. Now, how does that, how can someone interpret that? Well, we have these two ore bodies, and in between these two ore bodies, there's about 12 or 13 kilometers, maybe call that 7 miles of space that we really haven't tested or tested to any degree. Henceforth, this upcoming program will start testing other areas that could potentially be ore bodies. Because if we think that eSite could be a 3, 4, 5, or 10 million ounce deposit, you're going to have to find additional discoveries within eSite. I'm talking just eSite as a project. You're going to have to find different ore bodies there to get to those levels. And there's everything's a possibility, but it clearly is developing into a major asset.
Yeah, 100%. And we don't have to go too deep into it today, but there's a lot of really cool content to potentially be made around the drilling, the process here, the testing, right? And just for people that are, really into this world of gold to understand it in depth, I do recommend going into first the news report, just right on the a2gold.com. You can check that out right into the news area, but then you can also go into the investors tab there and get a lot more in terms of videos and pieces along those lines as well. So good content there from the top. And someone did ask in the chat what the stock symbol is. It's AUAU on the TSXV, so AUAU.V. And then the other ticker is XXF on OTC CQ as well. So those are the two that you could check it up. You can look up a2goldcorp.com if you want to see more information as well, just directly to start doing your research. But pulling back to gold as a whole here for a second, one thing which we've talked about and we've honed in on it, but I think it's always good to discuss here. And I'm going to do a couple of screen shares here, but we're going to talk. So gold spot price right now is about 4,600 USD per troy ounce at the minute, I believe.
Yeah, 4630 to be exact.
Yeah, there we go. So let's show people a couple of things here. Spot gold price at the moment. You can take a look right here. 46.34. Nice comeback here, kind of in the latter portion of the day.
Yeah.
Yeah, and so people can see, though, we've just been kind of consistently moving up here, especially on the 1 year. It's a little bit more obvious, 73% at this point. And then one thing which you've mentioned was, some of these miners, these junior miners especially, have lagged a bit. Now, we can go back a pretty good amount of history on here, and people can see a little bit of what you talked about, right? Gold really hadn't moved for a while here up until 04. You basically had, from 1981 till 04, you were pretty much flat or a little bit down at the time. And then you started having that move from 04, and all of a sudden you were up, 300%. And then obviously now you've gone significantly higher. The junior miners, like you mentioned, and we can use, what's it called? A2 Gold Corp. If I can we'll pull it up with the .v. Perfect. We can use this. People can see your trajectory has been a little bit different, especially over the last year, up 510%. And if they pull out to the max, right, this has data all the way back to about 2018. And so it was sitting during that time period. And then you kind of had the gold, like, kind of slowly moving up over time. But then A2 Gold Corp had this, giant move that basically pulled up right at the end. And now it's been consolidating a little bit here over the last 6-ish months, 5-ish months.
Yeah.
And so we talked about how, it hasn't really been revalued within where gold is. But I'm curious, a couple things, just for people that go back and look at this chart. Why do you believe that there was, kind of down sloping and then boom, 500% move? And then two, maybe talk a little bit more broadly to this catch-up trade right now and, where you think companies that are, investors that are buying, your stock right now, like where you think they're valuing gold at for the theory of this discussion.
Yeah. So so the first question, if I think I captured it, is, why didn't move for a period of time? And then I think the second question was, what was the catalyst to start playing a little bit of catch up? And the third is how companies are valued. The first is, we took a position from 2019 to 2020-21. Our goal was to restructure the company, making sure it was healthy, I took over a company that had almost no money, had a 2 to 3 million market cap US, and really had no direction. So it took a few years to really restructure the company, get the people I wanted in place, get the projects I wanted to keep. Because one of the things I was blessed with was some great projects, 13 projects I had. But I thought that was way too many for a junior. It's hard for junior to do 1 or 2 projects well. 13 is impossible. So we used that strength, to be able to sell off those projects and replenish the balance sheet. So we spent 2 years kind of restructuring. Then we went on the offensive a little bit, but we were in a period of a very, very, very bad bear market in the junior mining industry. From that period of time, it's actually, one could argue, almost 17 years in the making. But the early 2020s were horrible. So once we had cleaned up the company, then the next challenge that faced us was just a very poor market. So we kind of battened the hatches and took a very conservative approach. I think in retrospect, that was absolutely the right decision. But during that period of time, it's hard to focus on the company, the structure, and not do a lot of work and then try to keep investor interest. So we use that period of time really to strengthen our balance sheet, do quite a bit of work in the context of a bad bear market, and position ourselves for a bull market. Now, we thought bull market could happen at any moment in time. Little did I know it would still take another 5 years. And in the beginning of last year, so somewhere around March or April, the market started taking off. We probably outperformed significantly. Well, I'm confident we significantly outperformed our peers for a few reasons. One is that we hadn't diluted our shareholders for that 5-year period of time. We took a very conservative approach, so we had a very tight capital structure and shareholder cap table. So when the market did turn, there's just not a lot of paper that everyone had issued, blew out their structure by 300, 400, 500%. We hadn't. We had only issued about 40 to 50% more paper in that 5-year period of time. And a lot of it was taken up by management and insiders who probably bought a combined 18 or 20 million shares, or over 20% of the share structure during those 5 years. So management insiders had been buying a lot of shares, putting in the open market. At the same time, investors were probably selling. So when the market turns around, we're in the best position. And I really believe that that's what happened. We were just in a great position. We made the decision to raise money, which we hadn't done. And that really, took away the risk of we're going to do a financing, took away the risk of we're not going to do anything. We started developing, and we, created I think today A2 Gold is one of the premier juniors out there in the precious metal sector. It's, in my opinion, checks all the boxes: jurisdiction, project, well-financed, great investors, management, participation, and skin in the game, and partners, validation. Great partners such as Kinross and Eric Sprott and Ingalls and Snyder. They're all have kind of validated, to a certain extent, our company by investing directly in us.
Yeah, Kinross Gold, that's a huge one that you mentioned right there. I actually took some profit, a little bit over 100% on my calls on them today. So shout out to KGC. They've made multiple investments into y'all. Yeah, the whole ecosystem just seems to kind of be benefiting and on the upswing here. And then, of course, probably one of the biggest things that's driving this that we haven't really talked about too much, and I do want to cover John Marmite as well, but before we get to that, is kind of the destruction of the dollar here, right? Yeah. And what's happening. And that's I think where people are starting to really see, like, why is it taking off? Well, what percentage of US dollars were printed in the last 5 years? It's like half or something of all US dollars.
Yeah, since COVID, right? So prior to COVID. I think but everyone has postulated the destruction of the US dollar. And don't get me wrong, I'm very critical of how the United States has been managing their finances. There's two elements to a dollar destruction. One is, irresponsibility or, carelessness on how you how you manage or the trust that you're given, that the world has given you by making it the reserve currency, and that the U.S. has failed 100%. The second is, well, what's the alternative? I mean, if there is no alternative, so the U.S. dollar will continue to reign, in my opinion, not because it's a steward of conservatives, of being conservative and maintaining the purchasing power, the complete opposite. But there's no one else there. I mean, what is there to take it? Is it the yen? No. Is it the renminbi? No. Is it the euro? No. So at the end of the day, it's kind of hard. I mean, is it Bitcoin? I mean, people pause. Is it gold?
Well, the transaction, yes, I agree with what you're saying of the concept of the US dollar is going to remain that main transacting figure, but it's the value of it, right? And that's why I think people are being driven into gold in other areas, and why you're seeing the price go up is more so just store value, right? Pure store value rather than currency necessarily, right? I agree with you. I don't think the US, I don't know if people saw what happened in Venezuela the other day, but the US dollar is well protected. The US literally just went in and took over another country like overnight, and like nobody said anything, and now they're meeting with Greenland officials today. So yeah, no, like it's the country's not going anywhere. It's just the fact that you're going to be able to buy less and less and less with the dollar, so people are going to look to hard assets and invest in those hard assets, and that's where gold and silver are running.
And I think that's what's happening, is that people know that there's a destruction of all currencies in the world. Every government has been irresponsible in how they've managed their currencies. I want to go back a little bit, because you had asked the third part of the question is how are these companies valued in valuations? I mean, it's hard I think they're a little bit different. I think companies that produce, such as the Kinross and the Newmonts and the Barricks of the world, get valued by different metrics. It could be just free cash flow, and it could be just the size of the reserves. There's many ways to value them. I'll point to the fact that the cost to produce an ounce of gold or silver has slightly gone up over the past year to year and a half. One of the biggest costs in producing gold is energy, so oil to a certain extent, and oil prices are down over the last 12 months, or at least flat. But gold is up 50%. So imagine that your revenues are up 100 to 200%, and your cost structure is only up 5%. Labor cost, number one, and then energy cost would be number two, and generally, and financing cost three. And financing cost in terms of interest rates have actually slightly gone down. So you're talking about a Goldilocks scenario, no pun intended. It is as good as it's ever been for the mining companies, and they're generating record amounts of free cash flow. How do you value juniors? And first of all, when managing the fund, it'd be rare that we would invest in a junior company that was a pure explorer. Like they may have found gold or found silver, but they haven't strung it together to come out with a resource or a reserve. That to us, so I always start from the premise that, first of all, I'm only looking at companies that actually have an identifiable resource, a 43-101, that I can kind of sink my teeth into and get to read and understand, is there an economic deposit here? Or what is the probability of it being an economic deposit into production? The way I kind of valued it when I was doing my fund is, something that I kind of coined 15, 20 years ago. Most people talk about how much a resource, a deposit, is worth as, dollars per ounce, right? So you have 1.5 million ounces. The market is assigning $50 per ounce in ground. That's $75 million. And that's, the historic way of looking at it. I think that's flawed. $50 an ounce when gold's $500 an ounce is 10% of the value of spot. So historically very high. However, $50 when gold is 5,000, which we're quickly getting to, would only be a 1% value. So a 1% value of the spot price. That is historically very low. The historical average is between 3 and 4% of spot. So if you show me an inferred resource of, 1 million ounces, to use an example, and 3 to 4% of the spot price has historically been the price, well, gold's 4,600, then you could argue that it's worth somewhere of around $150 to $200 a resource ounce, or an inferred ounce. That means that company should be worth 150 to 200 million US dollars. Now, If we go into a major bull market, I've seen numbers of 6, 7, 8%. And that's, that happened in 2006, 2007. Today, I've seen plenty of companies that have a million ounces of gold trading at only $25, $30. So essentially 0.5% of the spot, 0.4 to 0.5% of the spot price. I don't want to get too technical, but the juniors are very, very cheap. And if you're a senior looking at these companies, you're looking at it and saying, well, man, I could pay 50% premium and still buy it for under $100 an inferred ounce. It's a no-brainer. I think that will set off this M&A race, and it will happen.
Got it. Makes sense. Breaking it down into essentially just cost per resource is probably the best unit to go with there. One other piece of news that I want to make sure we touched on, this was recently posted by your team, was that you welcomed a new vice president of exploration, John Marma. If you want to talk to that for a second.
Sure, absolutely. John is a experienced geologist in the state of Nevada. So not only a geologist with experience in gold and silver, but one with gold and silver in Nevada. And why is that important? Because it's really important to understand what are the regulations, with BLM, with Forest Service, with every other permitting that you need to operate, or whether that's an exploration program or moving to a PEA or pre-feasibility or feasibility study. John really has a great understanding of all these issues, and I had a series of calls with him, with all the agencies actually last week. But I really didn't have to add much because John understands it very well. Besides that, John is an exploration and a field geologist. He understands what it is to walk the ground, as opposed to just looking at something on a computer. He does have a very good sense of of the feel of the area, knows the projects very well. And we were, I think, very, very lucky to pick him up. He has worked at Hecla, he had worked at Newmont, so he understands bigger and mid-cap companies very, very well. I think we're very lucky to have hired him. John comes to us from a private company in Nevada, so he's a Nevada guy. He's lived in Nevada. He currently lives in Nevada, and so he's currently at our site right now. So, John, you'll be hearing a lot more about him. We just started a week and 3 days ago, so it's now getting him up to speed on the projects, and I'll be meeting with him next week in Nevada. So stay tuned. It's great for our company, and I think it will allow us to now execute our business plan in a far more efficient and aggressive manner.
Exciting. Yeah, leadership is super, super key for these things, especially for companies of your size. Having the right people in place makes a big difference.
Absolutely.
I've got a question, and also shout out to the chat. Appreciate Legacy Architect people in here talking about learning about gold. Love it. I got basically a question of how people should think about a breakdown of let's say a portion of their portfolio that's being allocated to gold. I think a lot of people, probably have in their portfolio like a GLD or a bar or something along those lines. That's kind of like people's first initial move into this area, and then they can move into, obviously I've been trading KGC and I've owned KGC, right? Barrick we've mentioned. How do you think is maybe an optimal breakdown of someone's portfolio if they were putting, let's say 5, 10, 15% into this area, how they should think about direct exposure to gold, basically spot gold through these ETFs, major miners and junior miners, if you were breaking it down? And then how's your analysis going to differentiate kind of across the board? Because people kind of lump a lot of these all into the gold areas, but they have very different business models.
Yeah, I mean, gold is a physical asset, and the rest of them are you're investing in companies, right? So, whether you could buy chips or you could buy NVIDIA, right, which makes the chips. And I think it's the best analogy I could talk about it. It's hard. Every individual has different risk and return.
Well, maybe that's a good comparison there. So, like you said, NVIDIA, where's TSM? Like, who is TSM in this? Who should people think of as like a junior miner, like your position? Because people are very familiar with that chips area. So I like that comparison.
So companies that are, getting into the AI chip business, who are just starting up and looking to develop a chip that they could compete with either, Google, who are now coming out with chips, and that's not a small company, but, Tesla's looking to develop their chips, Apple, those are the big boys. And obviously NVIDIA and the AI sectors, I don't want to say 800-pound gorilla. They're 95% of the market share, right? And so then you have AMD. So that you would have the next tier down below who are looking to develop the next chip that could potentially contribute to the supply chain of those chips. And I, don't know the junior market of the chip industry as well, but clearly NVIDIA, everyone knows. In the case of the mining sector, you have companies that are producing cash, so you don't have dilution risk, you don't have you wouldn't have liquidity risk, and that they trade quite a bit. If I were to look at just a standard individual that is looking to speculate, not to be too conservative, but not extremely aggressive, I would start with gold and maybe a 3 to 5% allocation. If they were going to have a total 15%, then I would then I'd move on to the senior and mid cap majors and probably have a 5 to 7% allocation there. Because, and once again, this is a strategic allocation. Then there's tactical allocations, which in each of these, and I'll talk about that after. And then third category would be the juniors, and another 3% there. If that adds up to around 15%, then great. That's how I would allocate it. Now, there's tactical aspects. I think gold relative to the miners is very expensive. So I would probably lower my physical gold allocation from 5 to about 3.
Okay.
And then because the miners are acting as if gold were 3,200. The juniors are acting as if gold was 2,500. I'm using that as an illustrative way. So if the miners are not capturing the full impact of gold, then I would probably increase my allocation to the miners on both sides. So possibly 3 in gold, 7 to 8 in the seniors, or 7 to 10 in the seniors, and then 3 to 5 in the juniors. And once again, I need to clarify, when I talk about juniors, I mean small cap mining and exploration companies. And if they're small cap mining companies that are actually generating free cash flow and quite a bit of significant cash flow, because if they can't earn money at 3,500 gold, not to mention 4,600 gold, absolutely shouldn't be investing in these companies. And then the exploration companies are companies that actually have a tangible resource, something that you can sink your teeth into, look at the 43-101 and read about it and say, well, do they have a 500,000 ounce of gold? Do they have 2 or 3 million ounces of gold? That's what really makes a difference. I tend to have historically avoided companies that have, staked some ground and are going to be drilling and looking for gold. Finding gold and silver, I'm going to repeat this, is in the US or Nevada is not excessively difficult. Finding an economic resource is extremely difficult, right? So, and then jurisdiction to me plays a really important part, even mining and exploration companies, because I've always had this saying that if in Latin America or in Africa, it also applies. If you have a great project, you're going to lose it. If you have a poor project, you're going to lose it. And if you have a mediocre project, you can possibly survive, right? And so, but in Nevada and the US, your jurisdiction is protected by property rights, and henceforth you can have a great project and expect to keep it, right? So in summary, I'm going to give you my tactical allocation. It would be 3 to 5% juniors. It would be 7 to 10% seniors, and then the remaining into physical gold, probably around 3%. That's physical gold and silver together. I would be underweight those in terms of my asset allocation, just because they've had a monster run. And I believe the alternative, which are the mining companies, you're going to capture all of that gold price. You're going to be protected on the downside because they're already reflecting 3,500 gold, not 4,600 gold. And so if gold does correct, your correction, you'll be, I think it's already incorporated into the price of these companies that gold is operating at 35 or 3,600, not 46.
We've mentioned a couple of the seniors, Barrick, KGC. Are there others that you're fans of in that area? Have any others that you've been talking to?
I think that the best run company, and it's not even close actually, is Agnico Eagle. But everyone knows that, and it's already reflected in the price. They're so grossly overvalued, in my opinion, that it doesn't even warrant mentioning, but they've been overvalued for 10 to 15 years. But really, from an operational perspective, hands down the best company that operates there. I will say that if you're looking for operational leverage to the price of gold, Kinross continues to be probably the best one out there. I think Barrick has made some catching up. Barrick has some great assets, but was poorly run in my opinion from a management perspective. IM Gold continues to be probably a good investment in the sector. It's a small mid cap company. Luca Mining in Mexico, a lot of people have made a lot of money there, but there could be that next leg up there. And so those are the small caps I kind of look at. I sit on the board of Gold Resources. It's a New York Stock Exchange listed company. I think A2 Gold is, once again, I'm conflicted and biased, but it
Yeah.
continues to be a great story, which continues to be slightly undervalued. But, if you look at the rest of the sector, some of these companies are so cheap right now. A2 Gold is not as cheap as them, but it just offers far more upside.
Yeah, a lot of potential, well-run company, positioned well, I would say from my perspective, in the M&A space that could potentially happen this year. Clearly, you've got a strong knowledge of the entire ecosystem that's happening here, so it's very, very fascinating to me. I appreciate the two breakdowns there, both of the first outline and then the tactical outline.
Yeah.
That was pretty helpful as well. I hope people that are watching are taking notes, to be honest. Bit of a masterclass here in the gold world. We're going to move to some wrap up here as we're getting close to the top of the hour. Is there anything else that we haven't touched on today that you'd like to speak to?
Well, I mean, I'll talk about A2 Gold, and A2 Gold this is going to be, by an order of magnitude 3 or 4, the busiest year we've ever had in terms of
Okay.
drilling and news, and just a lot of great things that are happening with us right now, not reflected, in my opinion, on the stock price. And we're just going to try to get over this. There's been a lot of paper issued in the industry, and I think that it's being taken up much better than I had expected. So use some of these pullbacks in stocks to really get positioned in the junior side. I think the mining are great companies as well. Miners are very, very cheap, and look for the companies that are producing, that are making free cash flow. Because if you can't make free cash at 4,600, you're not going to make it at 3,000 or 3,500 in the case you get a pullback. Everyone's chasing silver now. Silver, I postulated, and I made the comment maybe 3 months ago on one of these platforms, I think it was yours, that I thought silver was going to go to 100 to 150, and I still stand by that. I think you could have a run up. The long-term price of silver, if you told me $60 to $70, I would sign it right now, because remember, silver is generally a byproduct of most of the production, whether that's lead, zinc, or that's part of gold. So we're going to have a very busy year. It's going to be great for the miners and for the exploration companies. They're still really cheap. I think gold and silver, could stay at the levels. If you told me oil 60 and gold 4,000, I would sign that for 3 years. All because you can make significant amounts of money under those conditions. So that's what I would wrap it up. I would look for M&A to start heating up. The seniors are flush with cash. The juniors are cheap. It doesn't get any better than that.
Yeah, I really like this area. I'm personally invested into this area. Speaking with you gives me a lot of conviction as well. And I'm excited to see what happens throughout this year. We did a space last night, 2 nights ago, that people can go re-listen to as well. Thank you to everyone that tuned into this show. We'll have more shows coming up later this month. Appreciate everybody that tunes into Wolf Financial Live. I hope people are watching and taking notes. This is an area that I'm incredibly passionate about. I'm putting my money behind where my mouth is. We're trying to bring on the best experts in the space, and it's going to be an exciting year. So I think a lot of people are going to reflect back on this. This is only January 14th. And you'll be thanking us. So thank you to everyone that tuned in. Peter, thank you as always for coming on. Pleasure.